Our total revenue growth stands at 7.6%, with an organic revenue growth at 3.6%. And this is above the original guidance, which was between 2 and 3%, and also the upgraded guidance that we gave in July, which was to be around 3%. This represents a better growth than what we have achieved over the 7 previous years. Our underlying profit margin is at 5.5%, and this is in line with our guidance in July. And we also have a strong cash conversion at 136%.
The on-site services organic revenue growth of 3.3% has significantly improved relative to previous years. It reflects a return to organic growth in North America at 1.8% and a sustained growth of 4.6% in all other regions. There were mixed performance on key indicators. Client retention rate has decreased 50 bps to 93.3% due to losses in healthcare in the second half. Excluding a specific one large contract, which we exited, retention will have been up 10 basis points. All other regions and segments are either stable or improved. New sales development was down 50 bps to 6.3% due to a stricter selectivity in the bidding process. Same-site sales growth was 3.1%, up from 2.6% in fiscal 18, reflecting a combination of more inflation pass-through, solid cross-selling, offset somewhat by a net negative impact from IFRS 15 of about 20 basis points. A strong performance in benefits and reward services with an organic growth at 8.5%, well balanced between Europe, North America, and Asia. Our financial performance is solid. Underlying operating margin was stable at 5.5% within group's guidance. Productivity gains compensated investment in growth. Net profit totaled 665 million euros, up 2.2%. Free cash flow reached 907 million euros, representing a strong performance following an exceptional performance in fiscal 18, and despite a significant increase in net capex at 415 million euros, or 1.9% of revenue, noting that last year we spent 298 million in capex.
Our focus on growth strategic agenda is delivering, with revenue growth exceeding our expectations in virtually all regions, and North America getting back to better growth. This year, we have invested in sales, marketing, training, digital, and IT, reinvesting productivity gains for the greatest impact to structure solid and recurring top-line growth. We have also enhanced our ability to execute on certain large contracts, and our targeting and signing discipline has improved. Renewed management vigor at all levels, coupled with some key recruitments, has helped to positively evolve our culture and further embed discipline throughout the organization. I am convinced that we are on the right path to better growth over the next few years, though our global retention and development KPIs are not yet where we would like them to be.
For fiscal 20, a weak fiscal 19 healthcare retention in North America will impact revenues in this segment. Education net new business in North America is expected to be neutral for the second consecutive year. Growth in all other regions and segments should continue to accelerate. Sodexo is planning to continue the Fit for the Future initiative to generate savings to complement the operational productivity coming through due to more discipline and step implementation. As a result, we are confident that for fiscal 20, organic revenue growth should be around 4% or 3% excluding the major sports event in Japan. Underlying operating profit margin for the year should remain stable, excluding the currency impact and any impact from IFRS 16 implementation.
Our strategic agenda is aimed at delivering market-leading growth. We are investing. We have the right mix of activities and the right geographic presence. With a sustainable and inclusive business model, there is no reason why we can't capture our share of that growth. And as growth increases, we will ensure that the investments being made to accelerate our growth will remain in check so that the effects of our enhanced discipline and our efficiency gains can flow through to sustainably increase the underlying operating margin in the years to come.